Hi, welcome to the channel. Now, before I switch over to my screen share and walk you through a lot of the charts and the data that you all tune in for, it's been a wild few weeks. A lot has happened. I hope my work over the last couple of months has assisted in some way. It's continued to be incredibly choppy. In this video, I am going to walk through many of the key charts and the data points that I believe matter. As always, I will walk through a high-level broader market analysis with some key stocks and ETFs as well. Now, the big question everybody has is, has the market already bottomed, or is the big credit event, banking collapse that everyone's expecting just around the corner? But I think it's probably a choose your adventure type of environment. I think we all know that there is a massive economic bear case as well as the speculative bull case. But I think we can probably break it down into a very simple question. Is it economic macro or is it market trends? But either way, for me, it's not an environment to be aggressively long or short. I think managing risk is absolutely key to surviving the current environment. Now, investor sentiment is showing a lot of fear. There are a lot of news headlines, negative catalysts, and over the last week we've had to deal with the Fed interest rate hikes. We've got Janet Yellen talking every 5 minutes, potential banking collapse on the horizon, and lots of other news-driven events. But what I will do is try to filter out all of that noise for you. Now, for disclosure, myself or my clients may already hold some positions in some of the names mentioned. As I mentioned before, I use a combination of technicals and fundamentals, and I'm told that I'm very good at removing a lot of the confirmation biases from the equation that you typically see from a lot of perma bulls and a lot of perma bears. Those of you that follow me on social media already know that I don't use the magical hindsight indicator. I timestamp all of my work, which is massively important. I use technical analysis in combination with company fundamentals, and I'm definitely not a short-term day trader. I could not think of anything worse to be doing with my time. I'm really looking for structural trends that will last weeks to months, elements of swing trading as well, but it is primarily systematic, process driven, that removes a lot of thoughts and feelings from the equation, and I'm told my work is among the very best. Now, I am well known for my ability to highlight the big risk on, risk off turning points in the market. Some of my recent time-stamped calls, we could go back 1 year ago, called the market crash a week before the event, the big rotation from growth into value, bear market rally in June, the exact top in August, the exact top in the US dollar, which marked the bottom in stocks, also the bottom in bonds, and the recent rotation back into tech. And we could go all the way back to the crash of 2020, and I do have a track record of being mostly correct, which does help in this field. So if you do find some value from my work, please do like, share and subscribe on YouTube, and feel free to follow and share on Twitter as well. But please pause the video, make sure you're comfortable with that important disclaimer before watching any further, and let's dive into the charts. Now, what I would like to do is just spend a really quick 5 minutes just giving a high-level, broader market overview. As most of you know, I like to start with the yield curve every month. Now, I get it, the yield curve is inverted, it's a predictor of a recession, but something that I am noticing that over the course of the last month, the yield curve has improved somewhat. Now, whilst that in of itself isn't a guarantee, we've seen improvements in the past and then it plummets again. So I'm very open to all possibilities here, but I think this note from JP Morgan is really interesting. And what they've said is that the stock market almost always bottoms well before a recession is over, and sometimes before we even know that we're in a recession. So that's quite interesting to me. But as you know, I pay more attention to the charts. The S&P 500, for example, is now trading back up above its 10-month moving average. The reason the 10-month moving average is important is it's a really good trend following model. And we can see that when we are below, or when we move below the 10-month moving average, it's of course a very early risk off signal. And when we move back up above it, it's a very good risk on signal. We've seen this with the dot-com bubble, the financial crisis. We've had the 2018 correction, of course the COVID crash and the recent crash as well. But we are now back up above its 10-month moving average. So for me, whilst it's not a guarantee, I think that's a data point that I think is really worth paying attention to. We can see that with the financials, again, holding on to key levels. I think if the financials were to give up this $30 level, then I think we are probably in an environment where the banks are doing what everybody says that they were going to do. But I also like to look at contrarian signals. The Economist look like they're nailing it once again. So I think as long as the financials are above $30, provided the S&P 500 is above its 10-month moving average, I think you have to be looking at buying stocks at the moment. And you know, we've had now 2 consecutive quarters of positive returns for the S&P 500. So you know, everybody keeps saying that the world is ending. That's not what price is telling us at the moment. We've got the Dow again looking like it wants to test those levels at around 345. We've had a big rebound this week in the small caps. Small caps, of course, are a very good gauge of market risk appetite. We've had a reasonable oversold bounce in the Russell 2000 this week. We've got the micro caps again continuing to flirt with those COVID crash levels. I'm not terribly interested in micro caps at the moment. I think a lot of my work is really focused on quality, finding good quality stocks. My work is really looking for a lot of buy low, sell high charts, stocks that are showing really good strength in the market. Of course, I have plenty of examples and names that you can add in a couple of minutes. We've got the US dollar index as well. Again, no surprises here. For those of you that follow my work closely, you'll already know that the US dollar index was center to my thesis to buy stocks in October. So again, if we do continue to move lower here in the US dollar index, that's potentially another bullish catalyst for stocks. But for me, my thesis at the moment that I'm working with is that potentially the US dollar index can catch a bid and start to move higher here. And of course, we'll start to see if the correlations start to uncouple with the dollar index and the S&P 500. But that's the view on the US dollar index at the moment. It is at the low end of the range, so we'll see how things develop there. And of course, the 10-year Treasury note yield, if we start to drop below these levels again, that's probably a risk-on environment for a lot of the growthier areas of the market. Of course, my work over the last couple of weeks has had more attention due to bullish calls that I've made in my weekly letters for technology. Again, the XLK is breaking out. We're seeing the same thing now with the triple Qs as well. It's doing exactly as advertised, breaking out of a 10-month base above Fibonacci levels. Of course, we'll see how things develop if it gets to 335 and whether this acts as some kind of resistance for the triple Qs. But I'm looking for outperformance from the tech sector. I think if we get back up above these 2000 highs, again, that's probably another risk on chart for technology. The correlation is still there with the US dollar index and the VIX. They are still moving in tandem. The VIX at the moment is at the low end of its range, so I think there's probably some kind of spike in volatility coming shortly. What that looks like, we will need to see, but the VIX is at the low end of its range. Typically when it gets to the low end of its range, it's reasonable to expect some kind of rebound in the VIX, and of course credit spreads are on the decline as well. Now, that's just a really quick 5-minute overview of the broader market. There's a million charts that I could continue to walk through, but these are the charts that I think matter at the moment. But if you are still here, it probably tells me that you're getting a lot of value from my analysis. So please do hit the like button. Let me know in the comments what you think as well, what stocks are on your radar. It all helps with getting my work noticed, so please do hit the like button. But let's start off with some charts that I've been posting to Twitter over the last couple of weeks. I've had a lot of questions on AI over the last couple of days because I have been covering the chart on Twitter since it rebounded from this $20 level. It has met our upside objectives, but again, like all good trend followers, we don't place limits on how far price will go. Ultimately, my own personal process is to use things like trailing stop losses, etc. It does look like it's potentially breaking out again. Now, there is still an hour or so left in the market on Friday, so we'll see how things close there. But this is the updated chart that I'm working with. It's not because I think AI is a great, fantastic company and a stock that you can hold until the end of time. This is purely a technical trade setup, but this is the upside objective. It's already met massive upside objectives, so for me it's really straightforward. Stop loss placed under these breakout levels and ultimately see how far things want to go. Apple is breaking out as you would expect, with the triple Qs and XLK breaking out. For disclosure, this is a high conviction idea that went out to our clients over the course of the last 10 days. It's off to a really good start, and again we're working with targets there around 180. Lots of questions on SMH because for those of you that again follow me and have done over the last year or so, you'll know that I made a big bottom call on SMH down here. Now, I am working with an upside objective here. There's another 20% upside. Of course, we need to look at the individual components. I think for NVIDIA, very, very conscious that we are approaching levels where we could see some kind of pause in the action. Again, I am looking for lofty upside objectives to ultimately be met. Like I said before, I like to use trailing stop losses and systematic process. It stops that guessing game that everybody plays about, is this the top, is it not the top? So ultimately, our trailing stop loss continues to move higher. We are continuing to cover this for our clients, and this is the target that we're currently working with. We've got AMD again pausing at logical pause levels, but we are looking for a further breakout above 105. Lam Research above 540, it might make some sense there. But this is one of the charts that I'm looking for some kind of indication. This is the semiconductors relative to the S&P 500. What you can oftentimes find is when we start to approach these levels in the relative charts, a lot of the big money institutions can start to take money off the table because there's no longer outperformance from the sector. So I am watching this level with a lot of interest. I think if this can break out above 20-year highs, then semiconductors, for you perma bears out there that are, can't believe that it's going higher, I would suggest that if this chart does resolve higher, then being bearish on semiconductors is going to be a mostly losing endeavour. But we'll see what happens when we test those levels. Google holding on to big levels at the moment. This is its 200-day simple moving average. I did think it was potentially going to be off to the races here, but ultimately it has pulled back over the course of the last week, but is continuing to hold on to big levels there. Meta, again, above 201, I think makes a lot of sense. Again, we've been covering this one since its breakout here at the start of the year. We've got XLC again approaching upside objectives. The biggest components of XLC, of course, are Meta and Google. So I think provided XLC continues to move higher, the hope is that Meta and Google continue to move with it as well. Tesla, again, looking for a move above 215. The RSI is still in a bullish regime. It did not reach an oversold condition, which is a characteristic of a downtrend. So the fact that we didn't reach an oversold condition tells me that Tesla's still in an uptrend, and it is holding on to its 50-day simple moving average. We did put that to our clients on the 16th of January for disclosure, which was basically a play on capitulation. We've got Amazon. I think it's potentially setting up. I've added in the 200-day simple moving average. I think if there's a breakout above its 200-day, then again, Amazon could well be off to the races. Block. Now, lots of questions on this one because last week I did cover Block on the back of the Hindenburg report on it. Jack Dorsey has come out and given his rebuttal. But again, just to go back to what I was saying about Tesla, it did not reach an oversold condition. So I think provided the market doesn't sell off hard, I think those of you that are looking at Block, I think there's a logical $90 target there. Big breakout in Monster Beverage this week. I did post this chart to Twitter a few days ago. Ultimately, it has broken out as expected. OLED, fresh 6-month highs. Again, we've been applying a trailing stop loss on this one. We've been covering this one for 6 weeks or so. Continues to move higher. SE, again, bullish above its 40-week simple moving average. Now, some of the names that I think are looking pretty decent in the current environment as well. Some names maybe you wouldn't expect, maybe names that you've never heard of, but OpenText Corp is in a beautiful uptrend and it's breaking out. Again, we've been covering this one a few weeks. Boston Scientific, now this is a massive 20-year base. I am looking at this. If this can break out above that $50 psychological round number, then Boston Scientific, it's certainly not bearish when you break out of 20-year bases. Bud, again, I posted this one to social media this week. Again, this is from our premium work last weekend, actually, breaking out, done as expected. I think a pullback within an uptrend offers opportunity. So let's see how far Bud ultimately wants to go. Salesforce, again, we're looking for these big round numbers. Now, Salesforce, when you look at the company fundamentals and you look at massive PE ratios, negative earnings growth, that's not typically the type of stock that I'm interested in. I'm really looking for reasonable PE ratios and 12 months growth. But there is a big stock buyback with Salesforce. So I think obviously investors are aware of this, and I think that probably explains why Salesforce continues to move higher. Occidental Petroleum in the energy sector. This is one of our buy low, sell high charts. This is the Warren Buffett zone. He keeps buying at these levels as his filings show. So ultimately we are working with upside objectives there in Oxy. Again, lithium continues to move higher. I have been posting this one to social media as well. It's had a massive performance over the course of the last couple of weeks, and it is outperforming the market as you would expect. SQM has been our pick from the lithium sector. It did advance around 16%. It has pulled back over the last couple of days, but if lithium is going to continue to move higher, you would hope that SQM could potentially go with it as well. Again, gold approaching upside objectives here. I think logically around that 193, 194 level makes a lot of sense. And uranium, this is from our ETF chart book. Again, it's an area of the market that maybe really only applies, I think, to professionals. I know the average retail investor isn't really interested in uranium ETFs, but again, low end of the range, one of our buy low, sell high ETF charts. And we also have cane as well, which I have been posting to Twitter. Again, it's off to a massive solid start. Again, I understand sugarcane ETFs isn't going to be appealing to a lot of you, but again, for the professionals amongst you, I don't discriminate where the trends are. It's broken out, and ultimately we've got a 1350 target on it, and it's off to an amazing start. I hope you've had a lot of value from my work here. Please do hit like, share, and subscribe. If you enjoyed our analysis, please do jump on to our website at honeystocks.com. We provide various memberships. We provide access to our premium weekend work, access to all of our high conviction investment ideas, which I will show you what that looks like in just a quick second. Access to our midweek halftime report, access to a wonderful community, access to all of my chart books on a daily basis, and also if you are somebody that is perhaps learning a bit more about technical analysis, process building, and removing a lot of thoughts and feelings from the equation, I'm told that I've built one of the best technical analysis programs out there, so feel free to check that out as well. But I am very, very unique in what I do. For example, all of the high conviction, quality over quantity investment alerts, all of our high conviction ideas are all logged. Everything is completely time stamped, all on our website, all of our big market calls. And you can go and have a look to see if the types of stocks that we like to recommend are the types of stocks that you typically buy. We're not recommending penny stocks, pump and dumps or anything like that. It's all high quality companies at good prices where I feel that there is a risk to reward proposition to be had. But you can go back and have a look at this over the last 5 years. I have logged every single one of them. We are currently running a spring offer, so again, feel free to check that out as well. But this is what our high conviction ideas look like. This is a recent idea that went out for Tesla, which was a play on capitulation, breakout, which massive performance from Meta. Short idea recently for the Russell 2000, which met our downside objectives. Netflix, good performer, Amazon, good performer, and ELF, massive performer as well. So feel free, as I said, to go and check out our website and do some due diligence. But I think typically my work is a good fit if you have a mid-term approach. Perhaps you're looking to get away from day trading because you find it too stressful. If you are maybe looking to learn technical analysis, I think if you're a professional money manager and you want to have access to logical, technical work, then again, it's probably a good fit. And maybe you're just sick of hunting around social media, stock twits, Twitter for ideas, and you'd like to just have a little bit of a home. Maybe we're a good fit for you, but encourage you to check out our website. Like I said, we are doing our spring membership offer, so again, feel free to check that out. But if you have stuck here to the end, thank you very much for watching, and I hope to welcome you very soon. Thanks.